Hey traders, it's Leaf West. Another video in my series of videos that I'm trying to do to explain or illustrate how I use my indicators for trading, whether it be intraday trading or swing trading, what have you. And hopefully you've watched the first video in this series that goes through the color coding of my trend tracking software, and that's the color coding of the candles. And that's a huge important part of how I trade. Intraday and swing trading, what have you. And now I want to show you how I use those colors as a trigger. And it's not as simple as I'm going to try and show you, because really what I do is I use patterns and support levels and resistance levels and a number of things like moving averages, average true range, support and resistance levels. I use all those things to help me make a decision whether I want to buy a stock. And and then I'll use the color coding of the candles to, in a lot of times, a lot of examples, trigger me long or trigger me short. And I have a rule which I'm going to show you guys, my rule. But when I show you the rule, I'm not necessarily showing you a spot where I'm telling you that I would have gotten long there, because I'm not going to spend time on the pattern or the support levels or what have you. The left side of my chart is 3-minute chart, and the right side of the monitor is the 1-minute chart. And I often use the 1-minute chart to help me get triggered long or short on a 3-minute intraday play. And I'm not going to show you the 1-minute chart. I'm just going to focus on the 3-minute chart and the color coding candles and how they can be used to trigger you long or short. Again, you would only use those in conjunction with a pattern or a level that you're trading against. So I'm trying to get that clear in the first place. So, this chart on the left hand side of my 3-minute chart is rather busy and rather noisy for the uninitiated, but I understand totally how all these lines work and what they're trying to tell me. But I'm going to peel them off. I'm going to pause here and peel them off, and then we're going to focus on a couple things. We'll focus on the first example we'll have is for example is Apple here. Apple on Friday. If you were not involved with Apple and you wanted to buy this new high on the pullback of this new intraday high, this pullback here, this level here was the top of the opening range, which I love to buy pullbacks to. It was a pullback into the EMAs. This is the 20 EMA right here. It's a pullback which held just above the ATR, which is this dotted green line, and it's above the 50% dynamic pivot level. So there's a lot of reasons why I would be looking for a chance to get long Apple here when it flipped back to green. And so I don't want you to focus on so much that this level had meaning. What I'm just going to focus on with this video is just how, assuming that this spot had meaning, what are the rules I use for using the color-coded candles to get triggered into a trade. So let me pause and clean up the chart. Okay, so did that all make sense? Probably not, but really, if you just look at this chart, what I'm trying to show you is just the changes in color of the candles and how those can be used for triggering you for a simple trigger to get long or get short. So again, this is Apple from Friday, from the 17th of August, and we had made a new intraday high, which I love intraday highs because textbook technical analysis is that you buy the pullback from that. So then it comes down to where is the pullback, and there's again what you want to see most times. I prefer, that's my preference, is to see some kind of obvious wave structure, an ABC structure ideally, off of the high into a level of support, whether it be a Fibonacci level on a retracement grid, or again top of an opening range, or EMAs, or yada yada yada. So in this example, there was a clear A, B, C move lower. So again, there actually was reason for support to support price here, and for the trade to go higher from that level. So that is a fact, but let's just assume it doesn't matter if it was or not. What I'm trying to show you is that once you've had the pullback, what I wait for is for the candles to go from, from green or dark blue to green to red and then back to green. And when it's the flipping from red to green after you've hit support, that's the place I want to look to get long. And there are times when you can get faked out by one or two or even three or four green candles that, you might get a quick bounce in this first candle here, and then say the second candle and the third candle don't break the high of that first candle, and they sort of chop sideways, and then you get another little flush down. And so for me, I have found that I prefer to use a two candle rule. What I do is I look at the high price for the first two candles for a long transaction. I look for the high of the first two candles, and I set a stop buy on the break of that, and then in some cases, like Apple for example, I'll add a couple cents to the limit price on that fill as a limit that I'm willing to pay on that stop buy, because Apple sometimes will move quickly. Well, it does move quickly, but typically, almost always, you'll get a fill on Apple. Sometimes, rarely, you'll get, it'll break that high and then bounce higher and not come back. But generally, those are too emotional that I really don't want to pay market. I don't want to pay a market price for Apple and get whipsawed by some market maker who makes me pay 50 cents more and then drops the price down right away. So I use two candles, and in this case the high was on the second candle and it was 642.85. So once price equaled that, I would get triggered, and typically for Apple my limit for a buy would be 2 cents above that, so I would be at 642.87. And sure enough, I would have got filled because there's enough candles that bounced around that level that would have filled me. And then when I get into a trade like this where I buy a pullback, I'll put my stop underneath the low of the structure. And in Apple's case, I usually put it like 25 or 35 cents below the low, because you can come back and test the low, try and get some stops activated and flush them out and then take them higher. So, but in this case, we went back to green, pulled back and turned red again, but we stayed above our stop, and then we flipped green again. And so actually, if you wanted to add to your trade, you could start looking at these candles, these lime green candles. Again, if you've watched the video on the colors of these candles, lime green is good. That's an uptrend and the strength is increasing. So you can see these small consolidating candles that you could say, I'm going to add to Apple as we break higher out of this little range, because we've made our pullback, we've made a new high of the day, actually made a new all-time high, and I'm going to assume that price is going to go to make a new high. And typically what I'll do for a trade like this, where it's showing strength of a new high of the day, is that you will have a core position on. Maybe you add your whole position here, and my basic rule, and it doesn't always happen, but my basic rule is that I will trade out part of my position when we break the prior high of the day, and I get some kind of signal. Whether it be here, we had a signal, we broke the high of the day over here, and we actually had a light blue printing of a candle, which warned me that price is moving too far away from the average true range, and that typically will need to pull back. So you could use the low of this candle, or sometimes I use the low of the candle before that as a trigger, as a trailing stop, because it can still keep going like it did here. It can keep going. This could be a kickoff to a real big squeeze. You don't know that, so you just have to make your best guess. So I like to use the volume zone oscillator, and I'll often use divergences. And so here really wasn't a divergence. So I would not necessarily panic on that candle. Well, not panic's not the right word, but I would not necessarily just quickly sell my trading position and just stick with my core. I'd want to see, well, I'd like to see a divergence. I'd like to see a lower high in this volume zone oscillator. And sure enough, we had that. So that's where I would typically sell my trading position. And on a strong trending stock that's making new highs, You keep your core and you add on pullback. So now we wait for the next pullback, right? So we had, in essence, an A, B, C structure. We go to red candles. Don't let the red candles scare you, because that's all we want that to happen. We want the stock to get as sold as it can, because then that gives us a better price to buy back our position. And we don't know where our trigger will be. And do you guess each candle that's a low candle? No, you can, but that's a tough game to play. What I would rather do is wait for the colors to flip back to green, and then take the high of the first two candles, which in this case was the second candle, at 645. And I'd put my stop buy at 645 and give it a couple cents as a limit for the price fill, and I would have got filled again. And my stop for this new trading position would have been below the low of this pullback. Sure enough, price just basically flagged sideways, right? And didn't really pull back. And there's no reason to sell out of your trading position, because you haven't taken out your stop. You have to give the trade time to work. And in fact, if you're watching this, you can probably say that we're getting contraction candles. We're getting a squeeze in price as well. But you can just do plain old. This is a plain old sort of bull flag, right? And you're just waiting for price to resolve itself, whether it's going to break up or down. And we have every reason in the world to believe price is going to go higher. And sure enough, price starts to go higher. And so you could even add on to your trading position when we break out of this pattern, and use a two green candle rule again. The high of the first two green candles coming out of this pattern is 645.20. So again, put it 645.20 plus a couple cents for a fill, and Bob's your uncle. And we push to a new high. And what do we have here? So then you wait for a signal, or you wait for a divergence. Here's signals in your light blue candles warning you of an extreme move away from the average 2 range in price. But again, we haven't had a divergence yet in my favorite indicator, the volume zone oscillator. So where did we do? We had a lower high here. So here's where I would take my trading position off again, keeping your core, because you have no reason to get rid of your core, because you have a strong trending stock. We pull back, right? This is late in the day, so this is getting really, the squeeze is getting crazy here, right? And if you want to place, I actually bought some call options for hopefully a gap open on Monday, right in here, right in here. I think I paid $10.90 for the 640 calls on this pullback. And but if this were to be a normal midday pullback, I wouldn't necessarily like to see just 3 candle pullback. I'd rather see a little more of a pullback than just this little tidbit. But what happened here going into the close was a classic squeeze. So let's go another example of price and how we handle that. All right, so here you have Apple from the previous day had a bullish finish to the day. The day opened up, got a couple of big range bars, which it normally does. Tries to break higher, can't break above sort of the prior swing high from the previous day, and it pulls back. But it's giving you every indication that possibly wants to go higher, right? The first pulse was to go higher, and the finishing of the prior day was strong. So you might be thinking, again, the bigger pattern is for Apple to go higher. So that goes hand in hand with all this analysis. But okay, so let's say that there's reason to believe that this pullback is buyable. We're actually making a higher low, right? So now we're waiting for a flip to green candles. Now again, if we'd only had 1 or 2 or even 3 red candles, I'd be a little more suspect of this pullback. But we had enough red candles to show me that we had enough candles that showed me that price didn't want to go lower here, to believe that this probably was the end of the red candles. That was enough red candles to make this more of a valid transition to green candles. Plus we made a double bottom here on the oscillator, and we're going back to above the 0 line, which is bullish volume. So again, some people pick the first candle high. I like to look at the first two candles. And it's no, if the trade's going to work, that's not really a big deal. If the trade's not going to work, you're going to get you're going to have a bigger loss. But you're going to get into less trades that don't work if you use two candles, I believe, than if you just use one candle. You will get some false signals with just one candle. Again, let's just look quickly. For example, here is, again, I'm trying to be glib here in terms of in just showing you a quick example. Here is a bit of a downtrend, red candles flipping to green, and it's not as simple as that. Again, it really isn't as simple as just red to green. Patterns, what have you, are the most important thing, and these are just a way to help you get long. But if you're just to look at the color transition, here's an example of red to green. You had one green candle, we had a break of the high of that first green candle, and that would have, in essence, triggered you long. But that second green candle's high wasn't broken on the subsequent candles, and it took out the low. Again, here's another one. You had red candles flipping to green, and the first green candle's high was taken out with the second candle. So by just giving that extra candle, you can a lot of times avoid having this happen to you. A downtrend comes down, you get a little bounce, and then it rolls lower. And in this case, you actually took out the high of these prices later, but in the meantime, you've gone from 632 down to 630, so you've lost a couple bucks. You might even have been stopped out because depending on where your stop was. So that's really how I use the candles to trigger. In part, what it does is it tries to give you a consistent, repeatable way to enter trades, so that you take emotion out of it. You have a systematic way of doing it, and you can just do it time after time after time. Take emotion out of trading. You just say, you know what? Should I get long here? Should I get long here? You just say, no. I'm going to stick to my rules, and I'm going to go on the break of the second green candle. Now let me get a bigger time frame chart up and show you that it works the same on, say, a 15-minute chart. So let me pause this. Okay, again, this is Apple, and actually this is interesting because I actually tweeted a chart on this pullback, and I actually did get long here with a bullish put spread on Apple as it was pulling back here, and then I got long like common actually when it broke the ATR over here. But I don't want to talk about the other reasons of getting long. I just want to show you the colors and how they can help you get long. And again, the pattern's the thing you want to trade, but the colors can help you make a sort of consistent trigger to help you in your trading. So this is a 15-minute chart. So again, I wouldn't consider this red to green flipping adequate enough pullback to really say, you know what, I'm buying this break of the here. Again, I use two candles and but I would never just trust this sort of couple candle pullback. I'd like to see a bigger pullback. I'd like to see a structure like an ABC structure. In fact, when I drew this chart, I said this was a small A, B, C into A, and this was my B, and then this was my C. So I forget where I actually drew the chart, but it was in this area here. It was in this area here. I think I had a target of, I forget what it was, but it was right in this area, and I said I had an arrow which showed saying that the price is going to go to new highs because we had broke the I'm getting diverted here a bit for what I'm trying to make on this video, but we had broken, this is to do with the pattern, we had broken the hidden symmetrical resistance on Apple, and we're pushing to new highs on this structure. We weren't at all-time highs yet. This was at 638, but when you make these new highs, you have to buy the pullbacks. For example, when we made a new high here, you buy the pullback. You don't know what the pullback looks like, right? You just have to watch it wave to wave. And in fact, we had this huge squeeze and then a burst forward, right? So a new high, so you buy the pullback, and so this pullback didn't give you an ABC to a level, in part because it came right after a big contraction phase. So you're not going to get the classic pullback. You're going to get sideways chop, and then price is going to take off, right? So that's you have to take all these things into consideration. But for example, here you could have said, here's a green candle. I'm gonna go flip long on the break of that candle. Well, we actually never broke that, but again, I have a 2 candle rule, and you know, was this the low candle? You had the next candle was inside, and you could have said that was bullish, right? The inside candle, we're at a target level, we're at a pullback, I'm going to get long. Well, you know, you don't know where it's going to stop. So the best way, unless you want to try and pick the bottom ticks and pick the top ticks, your best way to trade is to wait for the trend to confirm its intent, and it confirms its intent by showing you that the trend direction has changed, and that we're no longer in a downtrend, we're in an uptrend. We've got green candles. And then I use the 2 candle rule. So the high of the first 2 candles is actually the first candle, and that was, I can't, there's no indicator on this, but it was roughly 631.26. So again, buy stop with a couple for Apple. I put a couple pennies on that, and you're off to the races, right? And again, you can trade around a core position and do what you want to do. And again, I've got all my indicators stripped off here, so I'm not going to go into how I manage my core position, but that was just an attempt to try and show you on a bigger chart how you can use the colored candles to trigger you into a trade. All right, so for example, here's Apple again, right? So assuming that this pullback was a viable pullback for whatever reason, we then wait for the candles to flip from red to green. So 2 candle rule, the high of the 2 candles is actually the second candle. It's at about 393.40, and so you'd get long at 393.40 plus or minus a couple cents, and your stop would be below the low here. Now that's 363, right? So that's why when I see a swing pattern setting up on a buy level, if I said, okay, if there was reason for this to be a good low, that's when I flip down to a 15-minute chart and use that as my entry for a swing. And if I see a 15-minute pattern that I want to enter, I flip down to an even smaller chart on occasion to get triggered, because what you don't want to do is to have a $30. I don't want to have a $30 stop, even though that there's nothing wrong with that, because in essence, that you're trading a daily chart, and so you can trade daily charts, you can trade smaller charts, and so I want to try to trade daily patterns with entries off of a 15-minute chart, because that gives me the best chance for a winning swing trade, but it allows me to keep a tighter stop. And I think that's how most people trade. They don't just trade off of daily triggers and daily stops, because most people would be too emotional to do that, and I would be too emotional as well. So I'm not passing judgment on people. Okay, so that's how I use colored candles to trigger me into trades when there's reason to get into a trade. Again, the colored candles aren't by themselves reasons for trades. Again, I was talking about for example, let's go to the spiders, and let's look at Thursday's action, because I was pounding the table on Thursday about how this move here was part of a bigger move on the bigger charts. So when actually we were printing these candles here, I was telling people you have to ignore your targets and your signals on the smaller charts, because the bigger charts are taking over. So you have to, again, that goes kind of hand in hand with patterns. You have to understand that we're trading patterns and trading off of. Here's a perfect, this is that hidden resistance level that became support for the spiders. You have to understand how these all work together, and then you can use the colored candles for the most part when you want to get triggered into a trade. And just using red and green here, what are you doing here? You're getting in, you're getting out, you're getting in, you're getting out. Well, you have to understand that this is part of a bigger consolidation pattern on a bigger chart. So again, I hope people understand that these colored candles by themselves aren't the holy grail. They're just things to help you stay in trades longer, and they're things that can help you get triggered into a trade on a more consistent, repeatable method. Okay, guys, take care.